All right, question here is, are we in for a summer rally, or with all this blood on the streets and ultra pessimism, is it time to buy? Joining us now, Dave Rosenberg, who thinks not. He's chief economist at Luskin Chef, and we have Don Luskin on the other side. He's chief investment officer at Trend Macro. Gentlemen, welcome. Dave Rosenberg, good to see you. Thank you for helping us. Look, there's just so much pessimism, and I want to ask you, do you really see a double-dip recession in spite of even today's evidence from the ISM?
Well, the ISM was actually weaker than expected. And Larry, when you take a look at it in nominal terms and you take a look what the price index did, it was actually a very precipitous fall off. And it's showing you that the weakness in the goods producing sector is starting to creep into the service sector. I think that, sounding like a classic economist, double dip odds are probably at this stage a flip of a coin. But frankly, it doesn't really matter. I think we're going to have a significant slowing in growth, not unlike what we saw in the second half of 2002 under very similar conditions. And, you know, for a market where the consensus is looking for 3% second half growth, and the consensus, I mean, you talk about that there's fear. Meanwhile, the consensus earnings estimates for next year are still at a record high. I think that whether or not we get a double dip, the economy is going to slow visibly. That's going to cut into earnings estimates. And my sense is that the equity market may enjoy a technical bounce here. It certainly got oversold, but I still think is going to be going down through the summer into the fall.
All right, thank you for that. Don, let's come to you. What do you think of Dave's scenario? And Don, is there any good news out there in your judgment to counter this really manic pessimism, the likes of which I haven't seen in quite a while, maybe going back to 2008?
Larry, there's one thing we know as experienced investors, and that is that the kind of rampant pessimism that's out there today is the good news. When everybody is as bearish as everybody is, that means everybody that's going to sell has sold. And when all the sellers have gone, that means that there's no place for stocks to go but up. We have finally had the long-awaited correction in stocks. We are finally having the long-awaited rest in the recovery of the economy off the bottom 4 or 5 quarters ago. This is to be expected. It's never been a robust expansion, but it is at least some kind of recovery. Stocks are going to do fine probably by the end of the year. You know, maybe they'll get back up close to about the April highs, but they're a value play at this point. The fear is so thick you can cut it with a knife. I say start taking a dip.
All right, take a dip. Dave Rosenberg, I don't know if you believe in taking a dip into the market, but if you were to take a dip, where would you dip? But if you are not going to take a dip, where would you dip out? I guess those are my 2 investment strategy questions. Dipping in or dipping out?
Well, you know, if I was going to be in the equity market, I'd be focused on dividend growth, dividend yield, and the more defensive parts of the market, consumer staples, healthcare, utilities. But I come back to the question to you 2 folks. Understand the market's down 15, 16% after an 80% rally into April, but where exactly is this fear? Is there anybody out there really calling for a recession? How many strategists have you seen actually do anything to their asset allocation recommendations? What analysts are you seeing really taking down their earnings numbers? You had a Wall Street economist after the bell on Friday who was viewed as being bearish because he took down next year's GDP growth forecast to 2.6%. So how is that fearful? Do you really see capitulation?
But really,
when the VIX is at 50
really,
or 60,
David,
when market vein sentiment's at 20,
well,
okay,
right.
Let's talk. And when we get a serious reversal of this parabolic move in the past year, I mean, let's talk about fear in the market. There's no fear. We're going through a correction that makes perfect sense in the context of an economy that's slowing down visibly. The question really is, how far is it going to go to the downside?
It just seems like all the chatterers are pessimistic. Maybe myself. Right. Look, I've been a chattering pessimist all spring long. I just kind of suspect it's gone too far. But it's not about me. It's about you 2. Don Luskin, let me ask you about better news from Europe. Could that help trigger some kind of relief rally?
You know, Europe has been the dominant story during this whole correction. Europe has been the poster child for the idea that the credit crisis was in fact not solved. That maybe we recapitalized the U.S. banks, maybe we didn't, but oh my God, we forgot about the European banks, and now systemic risk is back. Well, some amazing things happened in Europe last week. The ECB stood up on its hind legs like a man for a change and told the European banks that it wasn't going to renew 442 billion euros, not even dollars, euros, in long-term financing. It was going to replace them with 3-month and 1-week financing. And what do you know? The world didn't end. During the week when everybody thought there was going to be the liquidity crisis to end all liquidity crises in Europe, 10-year yields for all the European countries, the good, the bad, and the ugly, all went down. It's going to be fine, folks.
Let me ask,
Larry, can I
yes, please
interject?
comment on that, because it just struck me that the demand for the demand for loans from the European Fed was really a lot less than anybody thought. And I'm so interested, David, in the rise of the euro. Look, the euro dropped about 20% against the dollar. That could have imparted some deflationary pressures on dollar prices and the dollar economy. But now the euro has come back 5%, and I want to ask you whether that changes the game. Does that mean, for example, the deflationary pressures here are going to abate?
Of course not. Larry, what hasn't changed is that in Europe, about a quarter of the continent is undergoing massive fiscal retrenchment. We haven't seen that impact our exports just yet. The UK is tightening fiscal policy dramatically. That's going to have an impact on our exports to that part of the world. So is there some signs of financial stability in Europe? Yes, there is. Are we going to be seeing tremendous negative impacts in terms of their decline in domestic demand growth from the fiscal tourniquet on our exports? There's going to be some residual impact here at home. But Europe is really just one part of the story. I mean, that's where I disagree with Don, that it's just one part of the story. I would ask the question, what did Europe have anything to do with the fact that new home sales in this country collapsed to an all-time low of 300,000 units in the month of May? Then you take a look at mortgage approvals for new purchases in the month of June went down another 15%. So in all likelihood, new home sales made a new low. What does Europe have to do with the fact that auto sales in the U.S. went down 5% in the month of June to 11 million? How pathetic is that? What does that have to do with Europe? The answer, nothing.
All right, tough
It has
stuff.
to do with the fact that the stimulus has faded, and so is the inventory cycle. That's the story.
Don Luskin,
David,
I'll give you the last word if you could do it quickly.
David, in David's list of 15 things that are terrible about the economy, one of them that he lists is the new low in consumer confidence, and this despite the fact that personal consumption is at all-time highs. That lack of confidence is surely in part being motivated by the constant drumbeat of disaster in Europe. And it's a disaster if they're not austere. It's a disaster if they are austere. It's the end of the world. This is the kind of fear I'm talking about.
All right, gentlemen, we're going to leave it there. Appreciate the debate. Very good. Dave Rosenberg, terrific stuff. Don Luskin, terrific stuff.